Investment experts say that returns and risk go hand in hand. But what exactly is risk? When it comes to investing, the possibility that the actual returns on an investment may vary from those that you expected is defined as risk. This also includes the unfortunate possibility of losing some or all of the original investment you made. This risk can emerge from various sources, and as a smart investor, you should not be afraid of it, but be informed and aware about it. And that is why asset management companies publish risk measures in scheme-related documents, so that you can make a more informed decision. So what are some popular risk measures that you should understand? Let us begin with alpha, which is a measure of active returns on an investment. Alpha tells you if the investment return outperformed the benchmark index return or the market return. Higher the alpha, the better the outperformance of your investment against the index. The benchmark index refers to any chosen market index such as the S&P BSE Sensex or the Nifty 50, against which you can compare how your investment is performing. Alpha is calculated simply by deducting the benchmark return from the investment return. For instance, if the benchmark delivered 8% and your mutual fund investment gave you 10% returns, alpha will be 2%. This simply means that the fund manager, through his actions, was able to outperform the benchmark by 2%. In general, a higher alpha is a good indicator of performance. Beta helps you judge how volatile your investment is compared to the volatility of the market as a whole. It indicates how likely the investment is to experience wide swings in value. A beta of 1 means that an investment in that product is as risky as investing in the market. If the market goes up, the product's returns will go up as much. A beta exceeding 1 indicates that the fund will, on average, swing more than the market. For example, if the fund's beta is 1.3, in theory it will be 30% more volatile than the market. So if the market goes up by 10%, the fund could potentially go up by 13%. A beta of less than 1 indicates that the fund will, on average, swing to a lesser degree than the market. So if the fund's beta is 0.9 and the market goes up by 10%, the fund may go up by only 9%. In general, risk-averse investors prefer investments with lower beta values because when the market goes down, chances are that their investment value will fall lesser than the overall market. On the other hand, those who are willing to take more risk can choose investments with higher beta values because when the market goes up, their investment value could potentially rise more than the market. Another common risk measure is R-squared. It is measured on a range of 0 to 100 and indicates the level to which the performance of the investment can be explained by the movements of the benchmark. For example, if an equity mutual fund whose benchmark is the S&P BSE Sensex shows an R-squared of 100, it is perfectly aligned to the performance of the Sensex, making the fund's performance an identical twin of the benchmark and perfectly explainable by movements in it. To conclude, higher R-squared values mean better correlated performance with the investment's benchmark. Let us now talk about standard deviation. This parameter reflects the historical volatility of an investment's performance. In other words, it measures the average variation from the mean returns over a given time period earned by an investment. For instance, let's say you invested in stock A for a 5-year time period and the mean return over the 5 years was 20%. There would have been times that its performance went as high as 70%, and there would be times it performed poorly, reducing your returns to just 5%, which means that the stock is very volatile and has a high standard deviation. On the other hand, let us look at stock B. Its stock price has also gone up and down but not as sharply as stock A's. Therefore, its standard deviation and hence its volatility would be much lower. When we compare the two stocks, one can observe that high standard deviation could potentially help earn higher returns, but there will be a lot of risk involved. On the other hand, lower standard deviation may deliver lower returns, but there's lesser risk involved. Your own risk profile will determine how you can view an investment product's performance potential through the lens of standard deviation. In general, investors prefer investments with lower standard deviation as their performance is generally more predictable. Let us now look at the Sharpe ratio. This ratio is a risk measure that is used to calculate risk-adjusted returns, and it indicates how much extra return is generated per unit of risk taken while investing in an instrument or security. Sharpe ratio is calculated as an investment's excess return over the rate of return offered by a risk-free investment such as government bonds per unit of investment risk taken as indicated by standard deviation. Therefore, a higher Sharpe ratio means the potential of earning better rewards per unit of risk you expose yourself to. Finally, let us also talk about the Treynor ratio. This goes one step ahead of the Sharpe ratio and helps the investor evaluate the efficiency of an investment per unit of risk using beta as the measure of risk. Treynor ratio is calculated as an investment's excess return over the rate of return offered by a risk-free investment such as government bonds per unit of market risk as indicated by beta. A higher Treynor ratio is an indicator of an investment generating better returns despite the volatility present in the market. In summary, a higher alpha, Sharpe ratio, and Treynor ratio indicate better potential performance. Lower beta and standard deviation indicate lower volatility, and a higher R-squared indicates a better correlation with the benchmark. Together, these indicators can help investors determine the risk-return profile of an investment and judge the real value added by the fund manager. So when you consider an investment product, don't make a decision based solely on performance. Understand the various risk measures and ratios and discuss them with your investment advisor. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.